Okay, in this video I'm just going to show you a little activity which links the business cycle with aggregate demand and the circular flow model. So just assume that the first flow, flow 1, our resources, our land, labour and capital being provided to the business sector are represented by different coloured poker chips, and each subsequent flow is represented by water basically filling up jugs to show all the different components of aggregate demand and our eventual real GDP. Assume imports have been removed from consumption, investment and government spending. So we're going to play a hypothetical game, and these are the kind of questions I'm going to ask you after I go through this with you. Things like, what is import spending, like in a boom compared to export spending? Why is this the case? What's likely to happen to Australia's debt in a boom? Why is investment spending so high in a peak and so low in a trough? Why is taxation so much higher in a boom than in a trough or a recession? How would this likely affect the budget outcome? Why is there a high level of government spending in a recession? And sometimes even more than there is in a peak? And what other trends do you notice? So the first phase is the expansion phase. So let's say that our supply of resources equated to 2 green poker chips, 2 white poker chips, and 4 blue poker chips. And they would represent our supply of natural or land, capital and labour resources to the market, flow 1, from the household sector to the business sector. In response to this, we get generated income. So the total level of income that we generate is 815 mils. So I'd fill up 815 mils of a bottle, and then basically that 815 mils gets separated into 4 different things. Some of it gets spent directly on Australian goods and services, consumption spending, good for aggregate demand. Some of it is saved, some of it is taken by the government in tax, and some of it will be spent on imports or foreign goods and services. So they will be our 3 leakages, and then that will flow back into the economy through investment spending, government spending, that they use our taxes to provide health and education and infrastructure, and we will also have exports, people overseas spending money on Australian goods and services. So our total level of aggregate demand during this expansion phase would be the 375 consumption, plus 60 mils investment, plus 85 government spending, and 125 mils for export spending. The reason I didn't minus this 250 mils of imports is because, as I said to you before, let's assume that consumption and investment spending has already taken those out. So the 375 is just consumption on Australian goods and services, which isn't always the case. Then we've got a peak. Okay, so you can see some features of this peak is that lots more resources are being provided to the market. There's 4, 3 and 8 as opposed to 2, 2 and 4. So there's a significant amount of resources being provided to the market. We have low unemployment. We're using more of our capital resources. And therefore the incomes paid is higher because more people are working. Okay, a lot of this money gets spent in consumption spending. We go and spend it on more Australian goods and services. That generates extra production. Some of it gets saved. But you can see the level of savings is less than investment spending because firms are looking to expand. Investment spending goes through the roof in a peak because businesses are generating lots of profit. They have lots of demand for their products, they have high profits, and they invest a lot. Taxation is quite high. Okay, a very significant percentage of this would be taxation. It could even be higher. Okay, probably be more like 450, 500 mils if I was doing it accurately. And that's because more people are going to be earning a lot of money, and therefore the government will be generating a lot of tax. People will be pushed into higher tax brackets because they're generating a lot more money. Much higher than government spending, and therefore that's going to generate big budget surpluses. Okay, large amounts of income, progressive income tax, large amounts of company tax because companies are making a lot of money, and the government spending less on, and I know this is directly related to government spending, but they would be spending less on welfare, which would help to boost the budget surplus. They may also need to spend less to try and stimulate our economy because it's growing quite fast. So one thing you'll notice is that the government will generally be running surpluses during a peak. There'll be lots of investment spending. And look at the gap between imports and exports. It's a massive gap. Okay, because we're spending so much money, we're spending lots and lots of money on imports. And that's leading to a big trade deficit. And it could lead to large amounts of debt in the future. So in a peak, okay, this flow 3 is large. It's 164 mils. There's lots of consumption spending, lots of investment. Okay, sometimes a bit of government spending because they do a bit of money. So the injections into the economy are quite large. Generally higher than the level of leakages, although I'll be honest, the way I've drawn it here, it probably isn't the case. But generally injections will be higher than leakages, assuming imports aren't too high. Contraction, okay, resources start to slow down. There's not as many resources provided, higher unemployment, less income. Consumption spending slows down. People start to save more, theoretically, or a higher percentage of their income. So even though savings is higher there, if I've done it correctly, and I don't know if I have, savings should be a higher percentage now. Investment spending slowing down because firms aren't making as much money. Taxation will slow down because there's not as many people working. There's no real link here, but the total level of aggregate demand is lower. Then we get a trough. Very few resources provided to the market. A low level of income is paid, low levels of production, low levels of income, low levels of demand. Consumption falls. Investment spending is really weak because firms aren't making much money. Government spending may be quite large though because they want to start to stimulate the economy. So they want to be spending money on infrastructure to boost aggregate demand. They might be giving tax cuts, so taxation is likely to be quite low. It's also going to be low because there's a lot of unemployment. Companies aren't making as much money, so income tax is down, company tax is down, they're not making much money. GST would be down because people aren't spending as much, and government spending is significant to try and push up our economy, and therefore we're likely to run budget deficits in the trough. Okay, that's a problem in the moment with Australia. Australia has a $45 billion deficit this year because we don't have significant growth, unemployment is high, and companies aren't making as much money because the mining boom is ending. And lastly, imports and exports, there's no sort of important link here. They could be higher or lower depending on what's happening with the economy. Domestic economic stability, really quickly. Again, most of these things are kind of pretty standard. Investment spending is pretty standard. Aggregate demand is strong but not excessive. It's causing inflation. Nothing sort of really important. The government spending isn't that high because they don't really need to stimulate the economy. But the important one is a recession. Okay, a recession, really low levels of income. Very few resources supplied to the market because there's not much need for them because of a lack of demand. Okay, consumption spending is low. It's still not as volatile as investment spending because people need to eat, people need to spend money, but investment spending is really, really low. Savings is generally low because people just don't have much money. They might have a higher propensity to save because consumer confidence is low, but if you don't have any money, you can't really save. Taxation is really low because very few people have jobs. Government spending may be higher. They may be looking to stimulate the economy, assuming they have some money to actually spend. They'll be doing things like they did with our last trough when they gave everyone $900, or they'll be investing in infrastructure, or doing something to try and prop up our economy. So generally government spending will be quite large. And imports and exports, look, import spending is going to be low because we don't have much money. Depending on how our economy is going, there's no real link to export spending. But overall aggregate demand is really weak. Okay, so in our game, what is import spending like in a boom compared to export spending? Well, import spending is high. These other ones I'm going to get actually answer instead of me going through them.